Good, good afternoon, everybody. It's Christian Thwaites, October the 26th. And thanks for joining us for our latest market webinar. I think I have to click everything here, make sure I'm okay. Hopefully these slides are showing up. And we're at an interesting day again because the S&P is pretty much at an all-time high. It reached one at close last night and it's up another 18 basis points today. So these are much easier to do when the markets are at a high, but they're much harder to do if things are either low or an inflection point. Now, I don't think they're at an inflection point. I think the market is up for good reasons, which I'll go into. And I think as the subject title today shows, we're on a kind of solid recovery. There is some inflation around, and we'll discuss that. And it's a continuation of the debate on temporary versus transitory. And actually, that's a bit of a binary outcome, and it can be actually a little bit of both. But anyway, we'll cover that as well. Okay, let me try and advance the slides here. So you've probably seen the boats, 87 boats or 77 outside the Los Angeles Long Beach port. Now, normally, this is not something which comes up in everyday conversation. Ports just function. They've always been there on the West Coast. The big ones are Seattle, one just down the road here at Oakland. But the big monster is the one down in Long Beach and LA. So big that it has to be in 2 counties. And I don't know, I think about 40% of the inbound traffic from across the Pacific is coming into Los Angeles. And this is what a supply bottleneck looks like. If you kind of screw your eyes closely, you can see that down there is a lot of containers stacked on top of one another. And there's only 3 ships being unloaded. Now, what are the other 67 doing? That's a very good question. But the LA port is still not functioning at the level that it should be. And I can cover that in a minute. I think some of these issues are going to go away. For example, just this weekend, there was a report that all of these containers, some of which are empty, and some of which need to be put onto ships to go back empty, can't be moved because they don't have enough carriers. So the carrier would be the truck or something that would holds the containers. So they stack them, while they're waiting for them to be moved. Well, there's an ordinance in Los Angeles, Long Beach, which says that you can't stack containers more than 2 high. So this guy went around and said, why don't you stack them 6 high and you'll free up a ton of space? And 24 hours later, the head of the port said, that's a very good idea. And so, if this photograph is being taken today, these containers would be 6 high, and that begins to free up the capacity, which means then the ships can come in and the cranes can start cranking. In a normal port operating at full capacity, there should be a ship on every single one of these cranes, either unloading in most cases. And the fact that it's so snarled up is because of so much of these containers have built up. We're not exporting as much to China as we're importing from them. So the containers come in full and they pretty much go back empty. I mean, the only thing we really send to China is liquid natural gas and soybeans. I mean, there's some other stuff as well, airplane stuff, but I'm talking about stuff which goes in containers. Some of these issues about the, oh my God, the hair on fire, the Los Angeles ports are completely snarled up and they'll never be active again, will go away. It's an issue about truck drivers. It's an issue about trains. I mean, there's a very simple solution on the trains, again, which hasn't happened. The trains come in, whether it's Burlington Northern or any other big 4 or 5 rail haulage companies, and they come in and they go all the way to Dallas, let's say, 1,500 miles, and then they come back again. Well, there's some argument for putting a railhead about 100 miles from LA, which there are plenty of them to do, with big marshalling yards there, and then just get them out of the port and then get them picked up from a marshalling yard, which is not right in the middle of the port system. So, I mean, there are some very practical answers to dislodging this supply bottleneck. I mean, Biden made a big point about having the ports run 24/7. That's fine. They are. Could argue that they probably should have been, seeing as the ports which are shipping to them are running 24/7. But again, that can over time be remedied. But anyway, the supply bottleneck, I think, there's plenty of good examples, plenty of good either it's empty shells or stuff stuck in ports or stuff stuck in ships. But my point is that this stuff goes away. This is a supply shock. I'm sorry, this is a supply problem caused by a demand shock. In an economy, it's much better to have a demand shock than a supply shock, because eventually supply catches up. Okay, so where are we in October 21? Well, we've had continued improvement on the COVID-19 cases. Obviously, that's all in the headline. But remember, we came off 2 quarters of 6-7% growth, Q1, Q2, and the expectation was that Q3 would be pretty much the same. Well, it isn't, and it won't be when it's finally published at the end of this week. It'll be more like 2 to 3%. So, make no mistake, the COVID Delta second wave and the flare-ups in the southern states, and the whole story, was very real and very big, and it definitely made people less confident to go out and buy things. And it made a lot of service industries, whether it's leisure and hospitalities or airlines, all these ones which could open up a lot less, a lot slower than they would otherwise have done. So, the top line growth has definitely been hit. Not going to go away. I think what's going to happen is we'll see the recovery kind of prolonged for longer, as opposed to kind of the V-shaped recovery which we're expecting. Inflation, there is inflation in the system. As I said, supply problems, they are real. I mean, everywhere you look, whether it's barges, truck, rail, ports, ships, containers, cranes, all these things are big capital items. You can't just replace them quickly. And of course, some things like, truck drivers is a very cyclical industry. A lot of people have been coming out of the truck driving industry. It takes a while to get them back up to speed and back in again. That's probably the easiest one to do. It's a lot harder to do for a port worker or a rail driver or operator worker. So some of these things, will be fixable. There are, as I said, mentioned points of inflation, but not in real wages. We have seen some wage increases at the lower end, and we'll discuss that in a minute. But really, I always take basic premise that for inflation to accelerate to the kind of levels that we saw in the 70s, and that's really the only risk here. 4, 5, 6% inflation annual running for about a year, to me, doesn't constitute a broad, uncontrollable price increase. It's just some price adjustments. But for broad inflation, I think you have to have a lot of wage increases. You have to have this wage pull. There's cost push when your inputs go up, and there's wage pull when there's just extra lot of demand. Real wages are not really increasing. Normally, yeah, but real wages are what causes people to go out and spend more. And I don't think we're seeing absolutely no sign of that on any great level. The Fed will probably announce their taper next week. How do we know that? Because they said they would do it last month. And this means that they're essentially going to start on this first step of dialing down the quantitative easing bond buying program. The rate increases will follow way after that. Way after that, probably 11 to 12 months, depending on how quickly they announce the tapering. We think they'll announce it as a $15 billion decrease every month. So $15 billion decrease every month on 120 billion level puts you at next August if they start in November. And then they'll start to think about the federal funds rate. Employment was definitely weaker in September. We'd expected a little bit of jump back in September with the unemployment benefits finishing and so on and things opening up, but it has been slower. Why? Because I think not all the jobs came back. Schools, not all schools were open. The leisure and hospitality industry didn't open up as quickly. So part of this is kind of hope postponed. Hope not in the sense of it's, is it going to happen? Of course it's going to happen. There's going to be stronger employment in the next, couple of months. We'll see job growth. The question of whether it's between 2 and 500,000. I know that's a wide range, but that's what we're looking for between now and the end of the year. The claims side is steadily improving. We've been commenting on that every week since last March, just because it's such a good indicator of people being let go, and they are definitely improving. And I think that economic activity, especially with consumers, should accelerate in Q4. The one thing which will keep them from spending to their utmost limit will be the supply problems. Let's remind ourselves on the COVID side, look, here we are below the European Union. So there's the European Union in the black line. And that's jumped up. There's a lot of countries in the European Union. So you can see Germany and France and Italy. Spain's not here. But you add all those together and they've gone through a small resurgence, but nothing like the one that hit here over the summer. I mean, they had a delta and they managed to, with roughly a population compatible with the US, they were able to stop that straight away. Ours obviously had this massive peak, but it's now down quite sharply. You put that down to whatever herd immunity, more vaccinations, more mask wearing, or what it is. But by some accounts, the herd immunity might be getting very, very close. I believe it's around about 80%. And the combination of the people who've been vaccinated, plus the people who've had it asymptomatic, plus the people who've had it symptomatic, it gets close to that number. So that's definitely moving in the right direction. And then the states who covered themselves in glory in August are all down at levels which were are much more manageable. So Texas, which was 20,000 in September, is now down to much. I mean, it's still quite high, but it's down to about 5,000. These are 7-day average cases. So the story there, of course, is that this is moving in the right direction and gradually moving down. And short of another wave that needs a new Greek alphabet attached to it, I think that a lot of this will now be not a sudden end where everybody just goes up, where you can go back to February 2020, but it'll be this sort of slow, gradual, cautious reopening with a lot of safety and mask wearing requirements and distancing and vaccination and all that good stuff. So here's where the growth is showing up. The Atlanta GDP now, guys, we had this, this is last year where we saw these huge decreases, and then they snapped back quite well in the middle of last year. And what we were expecting in 2021 was sort of like a 6 to 7% growth, which would have sort of got us back on track to where we were back here. And then they would kind of level off. Well, the first 2 quarters were great, and then the latest GDP now forecast for the 3rd quarter is 0.5%. Now, I think they're slightly low, but we'll see. We'll get the first measure, I think, on Thursday or Friday. So look for that number. If it's less than 3%, that's sort of within tolerance levels. If it's down at 1.5%, 2%, I'd still say it's okay, because they're making the GDP, this first estimate lacks a whole month's worth of trade balance. So and also some other primary inputs. So it is a little rough, and it will always get revised. But anyway, you can see the trends going down. And I guess my point is here that you usually don't get inflation in an economy that's growing that slow. We've got inflation flex points and lots of incidences where we can point to higher inflation, but we're talking about broad, systemic, covers every part of the economy inflation, if that's where you want to sort of measure it, by the 70s or something like that. And you just don't get that when GDP is creeping along at 0.5%. Again, a lot of talk about inflation. Now, this is the Twitter founder, Jack Dorsey, and he put this completely idiotic tweet out the other day. Hyperinflation is going to change everything. It's happening. I mean, this is a really stupid tweet, because not only for the fact that he's holding Bitcoin, which he hopes is a big inflation hedge, but hyperinflation has maybe happened 4 times in the last 100 years. Hungary, Zimbabwe, and of course the Weimar Republic. There's maybe a few others around. And that's when prices are doubling every few hours. I mean, hyperinflation is thousands of percent. And so it's a complete misnomer. It's like calling a light shower, a category 4 hurricane. It's like, well, whoa, you're using the terminology completely incorrectly. Now, so you'll see plenty of these things, and I'm afraid I'm just going to ask you to kind of, turn the page and raise your eyebrows and say, this idiot doesn't know what he's talking about. Because, hyperinflation is just something where is nearly in every case, it's a political decision. It's a decision by the politicians and the central bank to print money at an incredible rate. I mean, literally in the Weimar Republic, people got paid 3 times a day. They were to work 3-hour shifts, get paid, go and pay some bills, do it again, because the inflation was so rampant and so fast. So these are extraordinary conditions, which we're nowhere near to being close to. So I'm sorry to put this one up and hammer on it, but really I think you've got to treat that kind of tweet with the disrespect I think it deserves. And then you've got other people who are calling crypto and so on a hedge against inflation. Again, I think you have to look at what they're holding and what their motives are. There's a lot of these headlines. I don't spend a lot of time thinking about them. Crypto is a different argument than against inflation, but inflation, there's plenty of hedges against inflation which have been proven to be hedges, and other than jumping into crypto. Now, so this freaks out the monetarists, because those of you who were around in the early 80s, we were sort of looking at the money supply every 5 minutes, and it was M1 and M2 and M3, and then it was M0 for a while, and it was all about how much is the money supply base growing, because that is just a precursor to inflation. And that's the old Milton Friedman definition, where they said something like everywhere and anywhere inflation is a product of money growth or something like that. Anyway, it's kind of like a self-referencing definition, but there you go. But anyway, so what they're saying is, look, the money base was growing at 5-6%, during which time the economy, certainly from 2001 on, sort of averaged about 2.5%. So now you've got this big explosion in monetary growth. It was up 23%, and even now it's up 13%. And this shows up in the Fed balance sheet. But I mean, my kind of reaction to that is, so what? I mean, the money itself does not create inflation. It has to be used and spent and directed towards something. The central bank might have $2 trillion worth of assets. We're not about to go out and start buying cars and fridges and stuff. So yes, the money supply is there, but it doesn't mean it's always being used. It might be used for saving, in which case you're going to be staring at deflation, or it might be being used for other purposes like quantitative easing, which is not necessarily going to lead to inflation. So anyway, this is what the monetarist says. So anyone who's been to the University of Chicago comes back with this stuff, but I think it's sort of, way out of date in terms of being a good inflation predictor. And let's kind of zoom out a bit. The headline CPI, which is what you're hearing about, is 5.3%, and you kind of got to go back to 2008 when there was an oil squeeze on, which when oil was over $100 a barrel, to see that again, and then way back to 1990 to see that again. The core one strips out the volatile energy and food components, and that's slightly better. It's slightly more accurate, and that too is sort of add some of the highs. So I'm not denying that inflation is there. It's just that, well, if you were looking long term at this, you might say, well, this was very odd. What the hell was going on there? But this looks like it's all kind of traveling within the norm. Inflation spikes up sometimes in and around a recession, and then it kind of seems to moderate off again. It spikes up again, and it moderates off again. And again, this recession is very different from all of these, because these are nearly all caused by housing or credit problems. This was caused by people just stopping buying. But the one to look at is the shelter one, and this black line, as you can see, has been about 3%. It dips down, way down post the GFC, because people were getting rid of their houses and housing was cheaper. If you're a mortgage buyer and rents were lower. But this is the shelter one is very important, because this is 33% of the CPI. And this is affected by mortgage rates, which help it keep it down, and by rents, which keep it up, just because rent increases have been, certainly in the pipeline. Not very high, but they've certainly been around. And also house prices, and they've definitely been very, very strong over the last 12 months. So this is the one to keep an eye on. Because it really drives everything else. So it's there, but again, I kind of look back and go, unless this really, you've got a really big jump in shelter, you're not going to get a prolonged break upwards in the CPI. So I'm kind of coming back to this core story of, yeah, it's there, it's higher than it was, but let's not paint this picture that we're in a permanently higher plateau. I've used this before just because the obvious sectors that close, so anything people facing, the hotels, the airlines, the carnival ships, the restaurants, of course, all those kind of service businesses were sure. Yeah, they were absolutely on their knees back in spring and summer of last year. And so their year-on-year numbers are pretty impressive. But let's just keep this, again, somewhat in perspective. I mean, the rental car market is, you can see back here, this black line is sort of was flat for the longest time and sort of went up 20% in 7 years and then nowhere for the next 12 years. And then now this is 90% above its start point. So, 02. But you can see that, it basically went up 90% from its low, and then it's coming off very quickly because rental car business isn't particularly complicated. If you've either got a fleet that you can rent out at prices people can afford, or you can't. And the major rental car companies hurt, especially when sailing into bankruptcy and sold off its assets. So when the demand came back, they were busy in the used car market, which is pretty much that. Well, that's down here. This one here, which I'm pointing to, but it flows right through to the rental car market. So that capacity eventually will even out and come much more back into line. And people have had horror stories about renting cars in places like Hawaii. Those things aren't, going to last. Eventually you'll see, competitors coming on. It's not a business which requires, it's not particularly high tech. You need the fleet and logistics. And if these prices stayed like that, they would just be competed away, I think. But these aren't terribly important. I mean, they make good headlines, but U.S. airline airfares are mostly driven by business travel. They're a very small part of the CPI. I don't know, less than 1%. Actually, everything on here is less than 1%, unless other than the used cars, and that's a big one, and it's 3.5%. And that one's going to continue to go up. I mean, you can see that it's sort of increasing, had a bit of moderation, but I would see at least this staying at this level, perhaps creeping up again. Why? Because the semiconductor shortage has really hit car production. I mean, the inventory in most of the car dealers is about 1-to-1. They basically have one car for every one they sell. It's normally about 2.5-to-1. They've got 2.5 cars, or 3 cars for every, or 5 cars for every 2 they sell, however you want to think about it. But anyway, the inventory is incredibly low right now, so that's why you can't get deals. They're not going to give you anything, other than manufacturers' retail price. But that eventually will work its way out. Eventually these semiconductors, which are mostly, the shortage means that it's going to the high value items, and the car isn't particularly a high value item. I mean, it's a high cost. There isn't a lot of profit in it. You're going to make a lot more profitability if you stick a chip in an iPhone than you are in a car. So, I think this used car component is going to drift up a little bit. It's really tied to the new car production numbers, which are is under some strain because of the semiconductor shortage. Energy looked bad. I mean, last year's a very interesting energy story going on in Europe. And I mentioned that natural gas prices are very regional. In the US, we got tons of it, and it's quite easy to get around. Just stick a pipeline wherever the gas is in Western Pennsylvania or somewhere in the Permian Basin, and pipe it under pressure to where it needs to go. But in Europe, it's much harder. A place like the UK has to ship it in. mostly. And then, and if you're sort of, yeah, if you're sort of, Western Europe, it's got to come a long way, and sometimes got to come by ship. So, these are the natural gas prices in Europe indexed, and this is the natural gas prices in the US. You can see there's a huge difference. Basically, the US is paying less than half the natural gas prices than Europe is. Now they have spiked up and they've come off a little bit, but they're high. And I think this is the energy component is much more of a problem in European inflation than it is in the US. Why? Because we've got lots of energy that we can bring on tap if we have to. But anyway, so this, a month ago, this was just, reaching for the roof, but now it's leveled off a little bit. So the trending down is definitely good. On the bond side, we started out the year, if you can squint down here, at about 1%, and rates drifted up to about 170, back down to 140, and now they're up to about 160. I mean, you can see that by historical standards, this is still incredibly low, and is probably likely to remain there. I mean, it might drift up to 170, 80. I think the Fed would like to see it more like it is back here. We have these kind of double dips in that decade after the GFC, primarily because of inflation and deflation and growth fears. But I think eventually it'll settle in at about 2.5%. It's got a bit of a ways to go, but it's going to keep low just because the Fed is still buying a lot of the supply, and the supply is less than it used to be. Certainly by last year, the Treasury is borrowing less than it did a year ago, obviously, because we were in the middle of the pandemic. We had, I don't know, 2 or 3 or 4 big stimulus packages back to back. A lot of that stuff is no longer needed. So the supply from the Treasury is lower. The demand from the Fed is still high. So I think that will prevent the Treasury rates, going all the way up to 2.5. But the important thing here is the real borrowing rate. Now, if you're borrowing something at negative 3.85, you can make a single percent return on it. Then you're in. You're making money, and it's not often we drift down into the negative rate. We kind of got 3 instances of it here. That's when there was more of a deflation story. Rates were actually quite here, and then back here, this kind of scares people. If you've got negative rates, then you just don't really want to be in bonds. And that's what happened in the 1970s. I think this is going to trend up. It's not probably going to stay at negative 3.5 for very long, but all this is just the 10-year yield less the current headline CPI. And then this is another indication of the Treasury break-even rate. This is nothing complicated. It's just the 10-year Treasury minus the US 10-year Treasury inflation protected security. Now that hasn't been around very long, so the history on this doesn't go back very many years. It kind of goes back to where I started the chart, actually, about 03. But recently, with the TIPS market yields negative 1% roughly. So if you buy a 10-year TIPS today, you're guaranteed to lose 1% a year when it comes to redeeming. And so what this is showing is the difference between the two. So this basically says you're better off in nominal yields. You're going to the break-even rate, the inflation rate is 2.6 for you to be in nominal bonds rather than TIPS bonds. So that's definitely crept up. And it's been this high before. Some people use the 5-year number instead of the 10-year number, in which case it's a little bit higher again. So definitely the market is thinking about inflation, but again, I'm not too worried about this because we've been there before, and we've been there before in quite healthy economic times. This is a heat map which we have kind of cheated here and used. The guy's name is John Authors, not misspelled, but it's actually pretty good broad measure. And it's 30. If you kind of count up this box, it's like 35 measures here. And the economic measures are things like the CPI and the PPI. I haven't filled them all in because it's a very busy chart. And the PCE, which is the Fed's version. The inflation components are things like shelter, so car rental, college, the big ones, healthcare. Market indicators are things like the break-evens I just mentioned about. Consumer and business sentiment are things like the Michigan consumer confidence indicators that came out today. Good numbers, by the way. The NFIB, which is the individual small businesses. Raw materials are as you'd expect, so metals, energy. and agriculture, and wages are weekly, hourly, low skill and high skill, and then we've got the export forecast. So yeah, so what we're looking at here is the bluer it is, the more inflation, you know, is deviating from its past. And you can see the economic ones are the ones which are saying this the loudest. The experts are saying, and they can always be wrong, but these aren't just the sell side guys. These are, you know, people who are not paid to be bullish all the time, but they can see inflation, you know, moderating or not getting particularly high over the long term. As I mentioned before, it is really not showing up in wages. The only one it's showing up in wages, I think, is the small business wages, which is this one. But I'm a bit skeptical of that measure because in small businesses, whenever they're surveyed, they always say they're paying they can't find enough people, and they don't like having to pay them very much. So you know, if all of this line was this color, you'd say, oh well, then there's some real wage push inflation coming through, pull inflation coming through, but it's pretty limited right now. So you know, we've got some dark blues, we've got, you know, more in the normal phase as well. Anyway, so this is just, you can measure inflation hundreds of ways. This guy has done, I think, a fairly good heat map, about 35. I couldn't really argue with the components about what shouldn't be in there and what should be and isn't. So it's a pretty broad indicator, and the takeaway is, yeah, inflation's a little bit higher than it was, but it's not screaming, you know, runaway inflation, certainly not hyperinflation. Some of these logistic problems, you know, have eased again. This is just the freight service index, which is the blue one. So that's now 1% above what it was a year ago. It obviously climbed very high, and the other one is the revenue freight ton miles. So some of the demand is easing off. But now, whether the demand is easing off because they can't get it, or because they're kind of sated and the demand is all met, you don't know. I suspect the problem that I mentioned these supply problems at the beginning with the ports aren't going to go away overnight. They are real, but I think they're also eminently fixable. And we've also think of this as a demand problem, because, you know, here we've got industrial production still clicking, you know, nicely up from its base. So it's you know, it's up about 20% from its low last year. And here's the delivery times. This is, I mentioned this in the blog the other day. This is where manufacturers say, you know, it's taking me, this isn't measured in days, it's an index, but it's taking me longer and longer to get the supplies that I need in order to have my finished goods. So again, this is more of a demand problem. I mean, you can't really tell from this because it could also be a supply problem. But I think what's happening is suddenly a lot of these businesses were operating at one level of capacity for most of 2020, and then a different level at the end of 2020 into 21, and then at a different level again. And suddenly the demand sort of, you know, came hard and fast at them, and they weren't ready for it. I mean, they'd furloughed workers, they'd closed plants, they'd mothballed machinery, they'd you know, they'd taken out half the tables in a restaurant, whatever way you want to measure it. You know, the capacity you know, was cut, and I think a lot of it will, you know, come back again if the demand holds up, which I think it will. Yeah, house prices are going slightly bonkers, but you know, that's really low wages. Low mortgage rates and demand. But there's always, for years, there's been a problem with, and it goes on about 20 years of housing starts not really keeping up with the growth of the labor force. But this is a good indicator of things which might see some relief on that. In essence, essentially, we've had a supply problem with houses. I mean, other than the GFC, you know, the big financial crisis. Otherwise, since then, there's been house builders have been very cautious about you know, building to speculation or building without, you know, seeing the demand very clearly. But now you're seeing, this is just measuring housing under construction. So you know, this is 1.4 million, which yeah, we saw briefly in 06, but you know, this means that there's more supply coming. And then this is the rental units, because these are you know, these are multifamily units, five or more, and I've also added in the 2 or more. So essentially, it's anything which is not a freestanding house which people live in, and that can ramp up. It takes longer to build because it takes about 8 months to build a house. It takes about 8 to 16 months to build one of these things. But you can see that the supply is, is coming online. I think that's going to be a good relief to housing prices, especially going into 2022. As I mentioned, we've seen some job wages increased. Here's the leisure and hospitality. This doesn't surprise me. Unless, in the Obama years, the leisure and hospitality guys just kind of pretty raw deal. I mean, they just didn't see any wage increases for over a decade, and these are all in nominal. And then then a lot of them disappeared. A lot of them have, for employers to get them back, they've had to increase wages. These are very low paying jobs, and most of them, nearly all of them actually, are not full time, 20 hours or less. And then retail trade that's popped up a little bit, and then transportation and warehousing. So yeah, you've got some wage increases in some areas which have been had supply problems and let a lot of people go. Remember, the leisure and hospitality industry employed about 18 million people in February 2020, and it went down to 9, and now it's up to 15. So it's still a lot of places that need to be filled, but I think people were looking to get out of that business if they could. It's not exactly a great long-term career to have. So I think the wage growth is really, look across the line, and this shows the wage growth, the median wage growth. People who stick around, about 3.5%. Remember, inflation's higher than that. And then people who move jobs, are getting pay rises. I mean, that kind of makes sense. The quit rate is high right now, which I think is good. It shows confidence that people can quit their job and move and hopefully get a better paying one. Again, these are mostly in lower paid jobs. But the real earnings, are pretty awful. So, here you've got the nominal 5, 4, and 3, but this is what it is when you adjust for inflation. It's like 0.4, 0.1, minus 0.8, minus 0.8. And these are for hourly earnings, all employees, and includes, the group of people who are in more management jobs as well. So this isn't, this is not inflationary. I'm just sorry, I have a hard time getting my head around the fact that you're going to get a lot of inflation when you've got people being paid almost zero wage increases. I mean, they're going to have a tough time going out and spend beyond their normal means if they're not getting real wage increases. And the rise in the gasoline is like a negative consumption tax, because I think what happens is that they go out and suddenly they instead of costing $50 to fill up the car, it suddenly costs 65 or 70, and they begin to then stop buying other things in their world. So they might say, well, let's turn the heat down, we can't afford it, or maybe we can't go out to eat 2 times a week. So it's kind of deflationary over the long term, but it shows up as inflation. So I think with the low wage increases in real terms, and the fact that energy is going to take some of the purchasing power out of these pretty mediocre increases, means that we just probably won't get in big continuing inflation surge. Job market is healing. Gosh, this has been a long time. We got down below 300,000. Really, that's what we're looking for. Before this, it was about 220,000, but that weekly claims, in other words, people who left their jobs involuntarily. And it got to stratospheric levels, and it's been sort of coming down ever since. But if you kind of look over here, what happened this year is the decrease got halted dead in its tracks, with the Delta variant, and then we had, about a month's worth of every week was a little bit worse than the prior week, and now we've seen the reverse. So eventually, we're kind of a number 290,000. I mean, I've written about the seasonal variations. This is very volatile, and the seasonal adjustments are very difficult to make. I mean, I think the BLS, who puts these numbers out, do a really good job. It's very difficult to figure out, how many people leave a job, are genuinely leaving a job, as opposed to just getting rehired again. And things like education and is a big one, because there's so many part-time people in the system. But anyway, I think that this is going to drift lower. We might get a 300,000 print tomorrow. Thursday, sorry. But otherwise, I don't think it's going to be terrible. It's going to increase gradually, as will this, which is the new jobs number. This last number was nothing to write home about, 194,000. What we really need is, 300,000-400,000 steadily for a few months. When we've still got 6 million people, fewer people working than we did in February 2020. So, there's 22 million jobs lost, and there's only about 15 that have been regained. So there's still, labor participation is low. So we really need to start seeing these job numbers increase. And I think they will begin to in the back part of the year. This has also got a lot of attention. This is the quits number. Now, I am absolutely in the camp that the quits number is an indicator of confidence. You don't quit your job unless you're very confident that you have A, won the lottery, or B, can move to a job which is higher paying. Because if you quit, you're not you're not eligible for unemployment benefits. So this is the total farm quit levels, and it's 4.2 million on a workforce of 150 million. And it's very high in places like leisure and hospitality. It's almost all driven by that, actually. So, but I think generally this is a good thing. It means that people can get better paying jobs, especially the lower pays. It's really where where we want to see people have more purchasing power. And if people then move to higher paying jobs, then it behooves the company that lost them to either seek increased pay and wage, either think about higher increases pay and wages, or seek improvements in their productivity. And I think they're going to do both, particularly the latter. This has been a year for stocks. This is basically, if you see the line goes down, it means that treasuries are outperforming equities. And if the line goes up, it's the other way around. So 2009, we obviously since had generally equities have outperformed bonds, with some big times where for a year, in this case in 2011, sideways for 2 years. But obviously last year, when we saw the treasury rate go to 50 basis points, there was a massive increase, outperformance of bonds. And since then, it's been the reverse. And really, that kind of makes sense given the amount of stimulus and recovery we've seen in the equity market and the low rates of the bond market. So you can see that, for ever since middle of last year, equities have, outperformed. This is just treasuries, but certainly long treasury securities by quite a bit. But yeah, sorry about the change in color here, but but the market has delivered. This is today's number, so we're knocking on the door of 4,600. Today it's closed at 4,574. But look at the earnings. I mean, we went into this recession with earnings per share about 170. Obviously, they got clobbered last year, but then that increase has been spectacular. And if you took this number pre-2019 and kind of just drew a line up at that angle, you'd arrive probably below what we are today. So it has definitely been the case that the S&P 500 has delivered on earnings growth, and they continue to do so in today's this season's result season. Yeah, I've talked about this. There was a big rotation to small and mid cap earlier in the year. It's squeezed up right now. It's got the small caps up 24% and the top 5 up 21%. It's all kind of bunched in here right now. It's been much broader market. In other words, all the kind of different market caps have moved in roughly the same direction. I'm going to spend just a minute quickly on Bitcoin because it's just on everyone's mind. I'm not going to go into a long discussion about Bitcoin. We are putting a Q&A together on Bitcoin, which we'll hopefully have posted up on the web within a week. It's been 99% done by a very, very good intern we have for the summer. So we now just need to finish it up and get it up there. But it kind of gives our thoughts on Bitcoin. But the bottom line is we don't think this is the way to buy it. This is the futures curve. So the CME is the Chicago Mercantile Exchange. So there was an ETF launched last week, which tracks the Bitcoin future. It doesn't buy Bitcoin because that's all secret and difficult, but it buys the futures on it. But look at the curve on this. It basically, is what happens if you get a lot of bullishness in an asset class. You can buy it at the spot level about 65,000, but you're gonna have to buy another you have to pay a $3,000 premium to be able to buy it in January, and more like a $10,000 premium to have it delivered next year. So this is what, futures curves normally look like. There's times when they don't, but this is kind of what a normal curve looks like. And an ETF which does this is, there are plenty of them actually, but this is probably the most famous example. This is an ETF called USO. You can look it up. And it basically buys the 1 month future of the crude oil. And you can see that it was always lagging the oil price. So they started off at the same level here, but here the lag is considerable. Why? Because futures are more expensive than spot. So what happens with this fund is it gets money in and it buys a 30-day future at a premium to the spot, and then the next day they do the same again. The next day they do the same again, and then the 30-day rolls off, and they keep on doing it again. So you're always going to underperform, because if the curve looks like it does, you're always buying it at a premium. And this one totally collapsed last year. So the oil price, came off quite a bit, but the futures price actually went negative for a couple of days, and this fund got absolutely clobbered. So if you bought a barrel of oil back in 2017, it'd be worth, for $100, it'd be worth 167 mid. But if you bought the ETF which tracked it, you'd have lost 35%. It's a big difference. And it's not just with oil; it's happened in this too, copper as well. If you bought copper, as a metal, you're up 31% since 2012. If you bought the ETF, you're only up 13%. In other words, the basic rule of thumb is if an ETF buys futures, it's going to lose money relative to the underlying all the time. And it's already happening in the Bitcoin one. So this is only 3 days worth of trading. So Bitcoin was down. This is the top line. I don't know, 4%, whatever, 3.5%, and the ETF's down 5%. So they've started off exactly as you'd think they would. This is just not a good way to play Bitcoin. And again, if you ever see an ETF with futures in its perspective, just run the other way. Emerging markets we haven't seen much clarity. This is almost the same chart as I posted last month. There's been a little bit of W-shaped recovery here, but right now, the outlook in China and emerging markets is distinctly chilly. Okay, so let me just summarize here. Delta seems to have peaked, which is good. Consumer activity is more coming online. The supply problems are real. I'm not sort of downplaying the port and all the subsidiary and related issues around supply, but I do think they are solvable and fixable. And eventually, if there's more demand, supply has a way of finding its way into the market, unless it's a government-controlled or a totally false market. But that's not what we're talking about here. Inflation, expect more spikes. You might even see things like the Jack Dorsey quote. Again, I keep that in, very much in check. I think what we're seeing is a period of inflation which was running at 1.5%. We might see a period of inflation where it's running at 2.5%. But if you're in stocks, you're well hedged against that. And I don't think it requires a massive rotation out of one asset class to another. The employment side is certainly getting better. The fiscal bills, I'm at the point where it's like, I'm not sure they're going to make much of a difference. We've got the real infrastructure bill, sounds like a big number, $1 trillion, but it's over 10 years, so it's $100 billion. $100 billion on $23 trillion economy is not a lot. And then the soft infrastructure one, which is more government spending, which is kind of being whittled away as we look at it. There's a lot of talk about tax increases, income tax for people above 400,000. That seems to have gone nowhere. Corporation tax moving from 21 to 25. That seems to be dying, or that might end up being 23 or something. Changes in the step-up basis, that's kind of gone away. This latest one, just this last week or so, is if you're worth $1 billion in assets, about 700 people in the United States who are, or you weren't more than $100 million a year for 3 years, there's essentially kind of well, it's not really a wealth tax, but it's a tax on unrealized gains. I don't know. I don't think they'll be able to get that through, but we'll see. But it doesn't raise a lot of money. So I think the market is just pretty chill about all this. And I think the bills are important from a societal point of view, but from a financial point of view, that the markets have discounted it. I'm not too worried about a stock market sell-off coming as a result of big changes in the tax treatment of stocks, or indeed the companies that operate in the stock market. And then the Fed will taper. So next week, I'll probably send a note around that they'll have announced it. I'd be shocked if they didn't say something. And then the only question is, how much? $15 billion a month, we think, and when they start, we think it'll be around about December. But that's sort of, a gradual tightening of the monetary conditions, and but something that the market, I think, is comfortable with, and that's why I think we're obviously riding right now very high based on some another very strong earnings quarter. Good. Well, thank you very much. Let me just see if I've got any questions. If not, I'll be happy to take questions that come in afterwards, either by text or email. Let's see if there's a couple questions. You've talked about how inflation and supply chain concerns may be exaggerated, but when you look at what might impact our portfolios in the next 12 months, what does worry you? Thanks. I think mostly what's going to worry me is the disappointment in the lack of labor growth. Labor participation has gone down, and we're still, as I mentioned, 6 or 7 million, depending on which survey you use, fewer people working than they were last January or February. We need to get those people back in the workforce for a lot of reasons. They need to be earning, probably could earn more than not earning. It's we're kind of not using our full capacity. So I think if there's a blip on the job side, we see a run of 100,000 new jobs a month or something like that, then that would be worrying, because I think it would show that the demand has really been clipped badly, and there's something more permanent about the shifting in the labor force. So that's my biggest concern. I mean, I worry in the sense that how other people will worry, so second derivative about we get a few runs of inflation, but I think that people might sell that off if they are worried about it. But I would see that as somewhat as a buying opportunity. I mean, I think that companies can manage a 2.5% inflation environment easily. I mean, they did that in the 90s, for a decade and a half. So and they even did it at a higher rate. So I'm not particularly worried about that, other than people making a bigger deal out of it. But I think my biggest one is the labor side. This is one of my favorite clients. I spent much of September in Europe on vacation, blissfully unconnected, but noticed via my latest statement that looks a pretty good haircut in September. Presume others might have too. Underlying causes for this or usual September-October volatility. I mean, I think some of that is, you get rebalancing. So as I mentioned, showed that, chart which showed how much equities had outperformed bonds. So there's a lot of portfolios which balance rigorously. You think of the entire target date maturity fund industry, where Vanguard and State Street and everybody under the sun, has these target date funds. And if domestic equities, went up, it meant that the bond component was low, and emerging markets went low. So they literally sold at the top performing asset, US, and bought what they thought was cheaper, fixed income and emerging markets. So I think some of that's been happening, and that might happen again in December. It tends to happen at quarter end, or ahead of quarter end, I should say. So I think that there was some of that. But the market has sort of bounced back, and I think what was happening was the jobs numbers weren't particularly good. The 190,000 when we'd had 500,000. The claims numbers weren't shifting, and the inflation was out there, and then the Fed was, really didn't seem to be reacting. And I think people thought, well, are they reacting because they don't see a problem, or are they just not reacting because they're asleep at the switch? And I think the talk in August and more recently is that they're not asleep at the switch. They do recognize that some inflation is out there, but they're putting it very much in the camp transitory. And I think that recently the market has got more comfortable with inflation. So hopefully the haircut has reversed itself a little bit, and hopefully your statements, look at them today, should see some of that reversed. What portfolio traders would expect for bonds if rates keep rising? We probably bring in the duration a little bit. I mean, our duration's pretty low. I mean, it's a 5 or 6. 10-year Treasury duration is 9, for example. So we try and bring in the duration a little bit. In the past, where we've seen rates sort of increase quite rapidly, which they did in 2018, we've used floating rate notes. And we might use those again, but for the moment, you're starting off with such a low yield because the Treasury floating rate notes are pegged off the 1-month T-bill, which is, I don't know, 3 basis points or something, not even. But so floating rate notes might be something. Otherwise, and mortgage-backed securities tend to be okay. But I think in all of this, we'd continue to stay high credit, because if you did get a big increase, if rates rose rapidly, then the guys who are most indebted, the high yield guys, are going to be in more trouble. And then for some people, we've done this kind of, one of a better word, ladder approach, where we've sort of bought, one bond at 1 year and one bond at 10 and something in between. So as they roll over, they reinvest at the higher coupon rates if rates are increasing. So we'd certainly be doing that as well. Good, thanks very much. I think I've covered them all. Yeah. Okay, well, thanks very much for everybody. This will be posted up on our website, and I think it's a podcast too. So please feel free to jump into that, or tell your friends that they should jump into that. Don't need to see it again. And I will see you next month, and some of you I hope I get the pleasure of talking with over the next few weeks. I'm now going to read the disclosure. So for those of you who love disclosures, this is the high point of the presentation. For those of you that don't like disclosures, feel free to do what you need to do. Okay. Discussions of the investment strategy, research, investment process of Brian Janikowski, as of the date indicated, as of the date of this presentation, are subject to change without notice. Charts illustrated throughout this presentation may be updated periodically. We have no obligation to provide revised assessments in the event of changed circumstances. We cannot assure that the types of investments mentioned in this presentation will produce the intended results or outperform any other investments in the future. We reserve the right to change our investment perspectives and outlook without notice as market conditions dictate and additional information becomes available. Diversification does not protect an investor from market risk and does not ensure profit. The information is subject to unintentional errors and changes without notice. All sources are from facts unless otherwise noted otherwise. While we gather this information from sources we believe to be reliable, we cannot guarantee the accuracy or completeness of any statements or numerical data in this presentation. References to an individual security should not be construed as recommendation to buy or sell that security. Securities noted in this presentation are only several securities, successful as well as unsuccessful investments by Brian Janikowski, and do not represent all the securities we have purchased, sold, or recommended. Index returns, reinvested dividends and interest, but do not reflect commissions or transaction costs. Mutual fund returns include reinvested dividends and capital gains distributions. Mutual fund returns are net of the fund expenses. They do not reflect Brian Janikowski's fees. Please read the prospectus carefully before investing or sending money. Past performance is no guarantee of future results. We may reference various hypothetical investment illustrations. These are for illustration purposes only and not investment recommendations. Do not guarantee any indication of future results.